Do you have questions about how to analyze stock? Check out this video where we're going to break down the fundamentals of a company that we follow and invest in, Alibaba.
It seems like every day you hear something new about Amazon or Jeff Bezos flying into space. But what about Alibaba, a similar e-commerce giant in China? Alibaba just launched a new server chip to boost its cloud business in challenge to Amazon and Microsoft. The best part is that the stock has fallen nearly 57% from its all-time highs. These are just some of the reasons why we like Alibaba as a company and an investment.
Hey guys, it's Amber and Jared here from Holy City Family. Our goal here is to empower you to achieve financial independence and provide the best education to your children so that everyone can pursue their dreams and ambitions.
If it's your first time here, thank you for joining us. Make sure to hit the subscribe button and the bell to receive our weekly videos.
So let's start with a quick overview of Alibaba. Alibaba Group Holding Limited provides technology infrastructure and marketing reach to merchants, brands, retailers, and other businesses to engage with their users and customers in the People's Republic of China and internationally. Trading at 41.4% below our estimate of its fair value, and its earnings are forecast to grow 13.48% per year.
According to the snowflake analysis from Simply Wall Street, Alibaba looks strong in value and in health. Future and past looks a little weak at the moment. Alibaba does not offer a dividend, which is typical for most growth stocks like this.
So as of October 19th, 2021, the share price for Alibaba is around $177 a share. In the past year, Alibaba's price has dropped over 45%, and 20% of that decrease was in the last 3 months.
Okay, now for a look at the latest news. Here's the first headline. Alibaba unveils one of China's most advanced chips. Alibaba Group Holding Limited unveiled a new server chip that's based on advanced 5nm technology, making a milestone in chip development in China. And this is what we were talking about in the beginning, where this is going to give Microsoft and Apple a run for their money. So it'll be interesting to see how that plays out. Next is Alibaba's stock is ready to make its big comeback before this fallout. And we can attest to this. We've been watching Alibaba and adding to our position over the past 6 months to a year as it's fallen. I believe it fell 57% from its previous all-time high. And so yes, it is definitely due for a major comeback, and it already has been bouncing back, I think a little bit after this article was written.
So the last article you see here is from Seeking Alpha, and it states 4 reasons Alibaba could more than triple. Over the next 5 years, analysts actually expect the company to deliver around 220% in returns, or 24% annually, with a 5 times the risk-adjusted expected return of the S&P. Historically, Alibaba has grown at like 14% of its worth, which is 26 times their earnings. It trades at 15.8 and under 12, including cash. The one interesting thing is it's 41% undervalued, and it's a classic Buffett quote-unquote fat pitch. So check it out.
Next, we look at valuation. Finbox.com shows Alibaba's fair value at $257 with a medium level uncertainty, leaving 49% upside potential from the current price. From 45 analyst targets, Alibaba's target price is $249.
When it comes to valuation, we actually look at a number of different methods to calculate the fair value for stocks that we track. When we look at this, like when you look at Finbox, they actually define that fair value as the real or underlying intrinsic worth of a company. And they use over 12 different models to calculate that fair value and also show a confidence level for each of those.
Here's a breakdown of future growth. The first chart you see is Alibaba's earnings forecast. The 3 lines represent high, mean, and low. The average 3-year earnings forecast is $12, which is a 42% increase.
The second chart you see here is Alibaba's revenue forecast. And like we said before, the 3 lines represent high, mean, and low, and now we're looking at it in terms of revenue. So the average 3-year revenue forecast is $206 billion, which is a 74% increase.
Let's take a look at past performance. The first chart shows the past earnings growth for Alibaba. Over the last year, Alibaba has grown 12% compared to the industry, which is also at 12%, and the market, which has seen a 19% growth.
And the second chart you see here shows us the past revenue growth for Alibaba. Over the last year, Alibaba has grown over 20% compared to the industry at 16% growth, and the market at a 12% growth.
Next, we look at the financial health of Alibaba. The overall score, according to Finbox, is great, and this is based on over 100 different factors that Finbox considers when scoring. And for the section below, they give it a B in cash flow and growth, a C in price momentum and relative value, and an A in profit.
Okay, with management, we like to look at several categories, but in particular, we like to look at the average tenure of management, the board members, the CEO, and the leadership. Here you can see Alibaba's average tenure for their management team is 6 years, and we like to compare that to Apple, which is 4 years, and then Microsoft for 6 years.
Okay, here's a breakdown of company ownership. So institutions are at 40%, general public at 32%, public companies 25%, and insiders 3%. So just to give you a frame of reference, we wanted to show how that compares to companies like Apple and Microsoft. Apple has institutional ownership at 53%, the general public owns 42%, and public companies own 5%. Microsoft institutions own 72% and the general public owns 28%. Now that we've gone through our analysis of Alibaba, we hope that this gives you a better understanding of the company and that you can make more better informed investment decisions. We plan to do a similar stock analysis for all the stocks on our watch list, but if you're interested in a particular company, let us know and we'll try to do that. We'll try to push that to the front of the list for you.
Throughout the analysis, we've shared some great tools and resources with you, such as Wall Street Zen, Simply Wall Street, and Finbach. We believe it's really important to get stock information from multiple sources to get the most accurate and up-to-date information. If you have tools and resources that you use, we'd love for you to share in the comments below to help out our growing online community.
If you like this video, give us a thumbs up and reach out to us in the comments below. You can also email and follow us on Instagram.
And our goal is to respond to every comment, read and respond them, and do that as often as we can. So make sure to subscribe to our channel and join us as we learn, save, and grow together.
Thanks, guys.
Bye.
Bye. Have a good day.
All of our videos are for informational purposes only and do not constitute financial advice. Please do your own research. Consult a certified and trusted financial planner who will put your interest above their own before following any advice we may offer.